What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is August 18th of 2021. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, I want to spend some time to dive into the current state of the crypto market. As over the last 3 days, we've been seeing a general pullback in the market. I not only want to talk about some key price points that we're watching, as well as some understanding around the valuation ranges we're currently at, but also talk about how you should measure your current portfolio against the market to see whether or not you are outpacing some of the safer bets in the market. And I just wanted to again say, as you guys can probably tell, I'm trying out my new standing desk that I just got. My beautiful girlfriend set it up and couldn't have done it without her. So trying to get a little bit better about standing up and gonna see if it works well with the video. If you guys like it, let me know. If you guys don't like it, please feel free to let me know in the comments down below and I can always adjust it. But anyways, guys, let's go ahead and dive straight into the video here. I want to first start by taking a look at the cryptocurrency markets at the moment and do a little bit of analysis on where we could expect things to go in regards to Bitcoin's price. So in regards to Bitcoin, first and foremost, we want to see what we've already seen back here in January and February 2021. What we're looking for here is what was previous resistance turning into new support. So we had that here back around the early start of August or late July, where we topped out around 42,000. We were able to come down, make a higher range of support, higher low here, move higher towards 48K, and it looks like we're going to come down and kind of scoop lower down into that previous resistance range, just like we did back here around 43,000 back in February 2021. I think that's a reasonable expectation here, guys, and this is the kind of healthy sign that showcases that we're going through a full recovery here back to the all-time highs. This is nothing more than a mid-cycle correction. The price action we're seeing here is exactly what we would expect. You know, a recovery here that's coming in just about as fast, right, as the downward move here, where we're setting in these higher ranges of support, higher ranges of resistance, or generally higher lows and higher highs, and eventually setting the stage to be able to move higher here for price and get back to the previous all-time highs. Right? Let's take a look at Ethereum here. Again, similar scenario. Ethereum holding up really well against Bitcoin. Again, you wouldn't be seeing this in a bear market, right? We're seeing here that, again, we had the consistent support range just like Bitcoin, came up here, and now it looks like we're looking to set a higher support range on these previous points of resistance here after the May sell-off, right? Now, it's important to see something like this because, first off, the next wave of capital likes to buy on intervals of discounts. So 10% discounts, 15%, 20% discounts. And what do you know, right here, we've got somewhere between a 10 to 15% discount around 13%. Right around this even range of 2,900, right? Big even levels, percentage declines in double-digit territory. That's what institutional buyers like to look for, or people who are looking to buy on the dip in order to climb prices higher, solidify that higher low, which is much, much higher than the previous one we had before. We really haven't set a higher low. You can maybe possibly claim here at 2,500. Back in early August we did, but a real, 15, 20% correction, potentially something slightly less at a higher support range that was previous resistance, setting the stage again for Ethereum to be able to start making moves higher, right? Again, we don't know exactly how it's going to play out, but the bottom line here is that we're looking for that higher support range. Now, in regards to taking a look at the overall market, I think total market cap actually gives us the best oversight into where we are right now and what we basically expect here. I think what we're going through is very similar to what we saw back here in the early part of August, where we went from 1.6 trillion down to 1.5 trillion, right? Testing on a previous support range here, right? Hitting that resistance range that weighed us down back here around 1.7 trillion, 3 times back here in May. Now we've gotten above that resistance and also a resistance level. And the reason why this was so significant is because it played resistance here and was also previous support. The bottom line goal we want to look for here is that we can make this previous resistance range new support. Again, same exact thing as we're talking about with Bitcoin and Ethereum, as they are the largest cryptocurrencies in the market. They're going to give us a good idea of where total market cap is going. So no matter where you're positioned in the market, it's likely that we're going to have probably another downward day or 2 days or 3 days, and maybe even have some time where we need to, again, hold this as support before we start climbing higher, just like we did over here or over here, where it takes a couple days. And then we eventually have the steam to move higher as buyers are solidifying support and starting to overwhelm on the market order side and drive prices higher, hopefully back to those previous all-time highs and into new all-time highs afterwards. Now, the second thing I wanted to focus on here, just again to kind of signify some confidence in the market, is something we've taken a good look at, which is, as you guys probably know, the altcoin season index, right? Now, I want to make sure my webcam's not in the way so you guys can see this well. We're taking a look at the yearly time frame. Again, as many of you know, as we talked about in our previous videos, when we're down this range, this is generally a range not to get bearish on altcoins. It's usually when altcoins are at a general discount, right? It's when we want to start to look for signs of a trend reversal. We don't want to FOMO in, but we also aren't looking to exit our altcoin positions, right? The time to do that was back here in April and May when things were exacerbated, if you are trading those intercycle trading opportunities, right? But what I want to focus on is, again, we were looking at this back when it was around 6 to 9 points here, which means that 6 or 9% of the entire top 50 altcoins were underperforming against Bitcoin. And that alone is a telltale sign that we're probably, in a general trend of discount opportunity for altcoins. But what we want to look for, again, is where we've seen this throughout previous history. And back here in December, where we started to see this kind of low test around 9, and we started to see prices moving a bit higher, that was the first telltale sign here that altcoins are starting to take over. Again, the index measures the performance of the top 50 altcoins over the last 90 days versus Bitcoin. Now let's go ahead and take a look, because last time we were looking, we had Axie Infinity and maybe a couple other outliers that were barely holding up against Bitcoin. Now we're starting to see a more solidified altcoin trend across the board. We're getting more players that are outpacing Bitcoin over the last 90 days. You've still got your Axie Infinity, Quant, Luna, some of these outlier plays, but you've also got Solana popping up here, Elrond, AMP, CRO, right? And you still got a variety of altcoins that are now starting to catch up back to Bitcoin even after the brutal May decline that we had. All right, so more and more of these altcoins joining the green family and eventually passing up above Bitcoin. Right? You've got a ton of players here that are right on edge in this case. And that's phenomenal considering we're talking about the 90-day average, which is still considering in those crazy highs back in May. So that's something just to keep in mind, guys. And again, you don't want to wait until you get to altcoin season. By the time, if we were to follow this, if we started back in March, most of the gains would have already been in for a lot of the plays, whether it be DeFi, NFTs, you name it, right? Now, I want to go ahead and talk a little bit about how you should measure your altcoin portfolio in regards to whether or not you should keep your allocations or not. It's not something that I don't want it to be the only thing you guys go off of, but it's something where you can set the bar a little bit higher and utilize ratios in order to make sure that your plays are outpacing the safe plays. Now, as many of you guys know, I talk a lot about comparing not just altcoins to their dollar pairs, but comparing to their Bitcoin pairs, right? That's pretty standard. If you're holding into an altcoin, the idea is that you want to hold cryptocurrencies that are generally outpacing Bitcoin so you can, A, maximize returns, and then also, at the end of the day, if you could just simply be holding Bitcoin, why not just hold Bitcoin to keep it simple, right? So that's the mindset here. But what I want to hint towards here is setting the bar a little bit higher and now measuring rather than just Bitcoin as a baseline, but rather using Ethereum as a baseline, creating ratios between your favorite altcoin and Ethereum, just like you would with your favorite altcoin to Bitcoin. And the cool thing is, even though if there isn't trading pairs for it, you can actually do this. And you'll see that in a lot of these charts, there is a lot of relevancy to that. Now, the reason I talk about this is because we've talked about the overwhelming confidence of Ethereum. It's not only a portion of our portfolio, but I think it's a portion of many people's portfolios, as even though it's the second largest crypto, it's heavily been outpacing Bitcoin over the past couple years. And about 300% return since we flipped bullish on altcoins back in late 2019. But outside of this as well, we've seen the market dynamics from staking start to really drive up Ethereum's price here over the long run. We've got over 6.7 million Ethereum being staked within the ETH2 contract. And with this has been about $21 billion of potential capital that could be sold, could be traded on a daily basis, now being moved off and removed from the circulating supply that's available for trading. That is an awesome supply shock dynamic. Not to mention, you've got another one here that as demand ramps up for Ethereum, not only is that obviously going to drive the price of Ethereum up, but with the implementation of EIP 1559, this is starting to actually make a huge drain yet again on the supply for Ethereum, so that when it's utilized, the protocol for network fees, a lot of it is actually getting burnt. We've already seen here, and I think later on today, we're probably going to pass over 60,000 Ethereum that is going to be total burnt since the upgrade back a couple weeks ago. And it's been phenomenal, 60,000 ETH that will never see the light of day for miners to go liquidate on the market. All of these upgrades on Ethereum, albeit they do have a focus on different types of gas improvements, keeping the network from being too congested, and then also eventually the improvements for ETH 2.0 in regards to scaling and lowering network fees long term. A big part of this is really setting the stage here to change the market dynamics, the supply and demand dynamics for Ethereum. And one thing that's really important to understand is that, right now, there's still way more issuance than what's being burnt. Ethereum is not deflationary yet. That being realized, this is already a massive improvement initially on the supply and demand dynamics that is going to benefit Ethereum's price. It's mathematically guaranteed in this case, right? The only thing that could change here is the demand growing or decreasing, and that would already likely be set in stone. EIP at 1559 doesn't really affect that, right? But outside of this, we can see that with the current proof of work issuance, right, as well as the proof of stake issuance, we still have more ETH being created every year, about 5.3 million versus the amount being burnt, an estimated 1.7 million. Now this can vary depending on how many people decide to utilize Ethereum or where GWEI or the price of gas is. But let's go ahead and take a look at a simulated merge here, right? Instead of 3.1% supply growth or inflation every year, when we do eliminate proof of work, at the current rate, this would mean that with the way that EIP 1559 is actually going about burning things, as well as considering the issuance for those staking, we'd actually be deflationary at this point. Now I gotta ask you guys something here. If Bitcoin is resting on a 1 or 2% inflation rate per year and is already doing as well as it is, and it's much larger in market cap compared to other cryptos, and then you've got Ethereum here, which is, yes, the second largest crypto, but is a fraction of the value of Bitcoin, and now is going to be setting up here in 2022 to be deflationary. That's going to be a hard asset to beat, especially with the growing demand. You've got supply shrinking in most models in this case, and you've also got demand continuing to ramp up as institutions are getting interested. I gotta say, it's gonna be very difficult to find plays that'll outpace this in the broad scheme of things. So I wanna go ahead and look at an example of how we can do this, right? Now, luckily, I'm looking at Uniswap here, or Uni token, against Ethereum. You can see here that sometimes you can find, actually in a lot of cases, you can find altcoin ETH pairs as it's becoming a little bit more popular. But I'll show you real quick how you could type this out even if there isn't a market pair, right? What we could do is Uni BTC. We'll go ahead into the down arrow here, give us the Binance price feed for Uni, and we divide it by ETH BTC. And just simply hit the down arrow, and then we would hit enter, and it would take us to a very, very similar chart, right? In the sense of doing my TA, though, I've already got it here on the chart, so I want to go ahead and dive into it. So this is like a great way of showcasing 2 points. One, how you could actually do technical analysis here of a altcoin versus Ethereum. And second off, as you will see in this chart, investors are watching this. Investors are definitely keeping an eye on these market pairs or these ratios, even if they have to make them themselves and there's not a tradable pair. We've talked a ton about ratios here on the channel and the importance that they hold. Take a look here at Uni to Ethereum, right? You can see here very clearly outside of the exacerbated wick here on the candle, you can see that we had a consistent support range here, not to mention consistent resistance at this general range here before prices could climb higher. And look at that consistent resistance range back here from the fall and winter of 2020 is now new support for Ethereum, for Uni against Ethereum, right? A near doubling in this case, about a 90% to 100% move here, right? Nice higher low here in this case, so significant base before moving higher. And along with that as well, we've got a nice little wedge building, lower highs, higher lows, coiling in price. As there is a generally higher low than the previous low, the bulls are in favor here. And it likely means that as altcoin dominance is picking up, and as Uniswap and other protocols in the DeFi space are gaining traction and adoption, that this will pop back up and not only revisit back to those previous all-time highs, very likely, but outside of that, continue to climb higher and possibly set at higher lows and higher highs, right? And to be honest, you give me something that is, at a bare minimum likely going to come up here and do a 147% move against Ethereum. That sounds pretty good to me, considering that Ethereum's already making great multiples against Bitcoin, right? So we have something here that is setting up here, showing the TA signs as well as the fundamental signs that it can very well possibly outpace Ethereum. Again, it's definitely subjective, and some of you guys might believe in this case that Uni might not be able to outpace Ethereum, right? There's a lot of different signs you can look for, but I generally look for price making higher support ranges on previous resistance ranges. That's a huge, huge benefit here. And this also goes as well for some of the plays we talked about yesterday, like Solana, right? So you can take a look at Solana, for example, which is holding up here quite well, right? Up here 0.02, right? It's been continuously setting in generally higher lows against Ethereum and making a nice bolt up higher to new all-time highs. I know a lot of people would be worrisome and say, oh, Nick, why would you want to buy something when it's at all-time highs against Ethereum? Well, the thing about it is that even though I don't own any Solana, and I'm not telling you guys are preaching to go buy it, I'm just generally sharing my thesis here that even though maybe you might want to wait for a pullback, or you might not want to FOMO in here, the bottom line is that we want to hold players that are outpacing the bottom underlying performer, right? And I'm not saying dump all your Ethereum, right? Ethereum is one of my largest positions in my personal investment portfolio. For full transparency, guys, it's because I love the Ethereum ecosystem. It's got the lead on DeFi, NFTs, everything you can think of. That being said, there can be other players coming up, as we talked about in our Protocol Wars video the other day. And we want to, if we're confident we're in a bull market here, buy into the signified strength here, because the idea is that this will continue climbing higher, just like how when we, let's say, give an example here, you cut out all the price action up into this date here, right? So we just got this range here from December and 2020 here to February 2021. Right, let's go ahead and take a look at that. Now, a lot of people will be like, oh my God, it's at all-time highs. I don't want to buy this here. I could have bought it here at 1,700 sats, right? Or 17, sorry, excuse me, we're looking at Ethereum. I'm losing my point here, right? We're at a fraction of Ethereum here, but around 17,000 right here, right? Why would I want to buy here? I'm paying double the price, basically. Well, after that, Solana continued to climb higher and higher. Now, again, another example here. It's at all-time highs. It's not pulling back. I don't want to buy it here. Well, after that, it's basically gone up to double that valuation against Ethereum, which is, again, already been doing great, right? So this is the general point here, guys. The thesis is that you can use ratios, or ETH pairs in this case, to know whether or not your altcoin that you're holding is a worthy position in your portfolio. And just because it's slightly down against Ethereum in the interim doesn't mean it's the end of the world. But again, you have to have either the rationale of why you're holding that position, either it's a fundamental long-term bet, or you need to be focusing on the time frame that actually makes sense for you in this case, in the broad cycle. And be comfortable with ditching plays that aren't keeping up, right? You guys might fundamentally like something, but it might not be serving you well in the sense of your returns. Plain and simple, right? We're here to invest in the market. It doesn't mean you can't go out and support the projects that you like, right? So anyways, that's it in regards to the market analysis today, guys. But let's go ahead and dive into our sponsored review today for Cosmos and their new decentralized exchange, the Gravity DEX. Alrighty, everyone. So in today's sponsored review, we're going to be taking a look over a project that's familiar here to the channel, and it's no other than Cosmos Network. Now, some of you may recall that we talked about Cosmos a good couple times here on the channel, but for those of you who are new to the project, we're not only going to give a bit of a precursor to what Cosmos Network really is, as it's aiming to build a hub or network of different blockchains that are tied together, but outside of this as well, we're going to be spending some time today to talk about a new exciting project that they just recently announced and launched, and it's no other than the Gravity DEX, which is going to allow for Cosmos to have a cross-chain interoperable way to swap between various different types of assets in a growing ecosystem of digital assets. So we're going to be diving into this and more throughout today's conversation, guys. But before we dive into the Gravity DEX, I want to be considerate of those of you who may be hearing about Cosmos for the first time. For those who haven't seen Cosmos before, the way that I would go about explaining it, and they kind of describe it here as the Internet of Blockchains, a very simple way to think about Cosmos is that it basically allows the fostering of different separate networks within the Cosmos ecosystem that can not only communicate with one another, interact with one another, but at the same time maintain their own governance process and maintain a high level of throughput and scalability through their implementation of Tendermint. So it's a really interesting overall protocol. This is, again, I think one of the many protocols that are up there to potentially be one of the layer one competitors in the protocol wars, which we talked about in one of the previous videos. It's definitely one to watch, with the native token being Atom, ATOM. So you guys are welcome to take a look through it. The big statistics here, though, are the range of digital assets that they have, either through the protocol tokens from the different types of networks that are built on it, or the assets that are tokenized and stored on the Cosmos network. Around $93 billion in digital assets, one of the larger numbers that we've seen. I think a lot of this is the advent of Binance Smart Chain, which is one of the many networks that have forked off the technology from Cosmos, and over 249 apps and services growing in the Cosmos ecosystem. Now, with this kind of range of adoption that Cosmos has seen so far, what I think is really exciting here, as you all know, I'm a big fan of automated market makers, decentralized exchanges as a whole, and DeFi as a whole. I'm very excited to see how Cosmos is making the move into DeFi, and they're doing it in a pretty bold way. They're not just building some kind of DEX or AMM. What they're really doing is building a cross-chain or cross-swapping ecosystem where a variety of different blockchain networks that, again, operate not so much in silos, but they operate in their own fashion with their own governance. They're allowed to trade and interact with one another over the Cosmos ecosystem, as well as eventually working towards bridging other layer one protocols outside of the Cosmos ecosystem into the Cosmos Gravity DEX framework, where you'll be able to trade practically any asset you can imagine. And this to me is really exciting because outside of something like Uniswap or PancakeSwap, for example, where you're trading Binance tokens in this case, or you're trading ERC20 tokens in the Ethereum network, right? You're now actually able to cross swap across different assets on different chains and standards. And that's very, very exciting. I think that's a very phenomenal potential opportunity here, as Cosmos' framework has been seen as quite popular in the sense of providing scalability. Again, as I mentioned, Binance being one of the biggest adopters here of Cosmos with the Binance Smart Chain. Now, let's go ahead and actually dive into some of the details here. Why is the Gravity DEX a really exciting technology here to watch in regards to the Cosmos ecosystem? So this launched back in mid-July here. Right, the announcement of the protocol coming live. And there's a few key things that are important to notice, right? With the ecosystem having the assets under management it has, this gives the Gravity DEX a lot of value, as you've got the liquidity to be able to trade, right? And that alone is the first major step here. You can build the greatest kind of AMM or DEX, but if you don't have the assets that actually require to be swapped between one another, or the liquidity, it really doesn't make sense to build this kind of technology. Luckily, we've got over $65 billion of assets here within these ecosystems that can now be traded. So that's a very, very exciting thing. Doesn't mean that that's direct liquidity in the DEX. It's important to note that. But at the same time, this is the liquidity that can start to trade here. And I think it's only comparable in this case to the amount of liquidity that you find in the Ethereum ecosystem. That being said, there's a really important component that Ethereum still hasn't nailed down yet, that Cosmos has. And that is cheap transactions. Now, I understand some of you might argue that, there's layer 2 systems like Optimism or Polygons, Uniswap implementations like QuickSwap, right? There's a lot of different layer 2s out there. The problem is that you have to bridge into these ecosystems. Whereas natively on the Cosmos network here, an average swap is going to cost you around 8 cents. 8 cents to make a swap, right? They charge around 0.3% standard liquidity provision fee that gets charged on practically any AMM, doesn't matter what chain you're looking at, and that averages out to around 8 cents. 8 cents here for transaction fees. The network fee has been the biggest roadblock here for people to engage in the DeFi space. So it's really exciting to see that with the Tendermint implementation for consensus, that scalability is practically not only guaranteed, it's showcasing through the numbers here for network fees. So again, really, really like, how this is working. Now they're also utilizing a new model, the equivalent swap price model, or ESPM, that improves price discovery for assets. So you have a lot of different benefits here that we can dive into. And there's a nice article they put together talking about 11 reasons why, in this case, the Gravity DEX is probably far beyond that of traditional AMMs in the sense of technology. Again, technology doesn't always stand at the centerpiece. Again, it does really matter if you can build the community, the ecosystem. You can have cheap transactions, but you need that liquidity. You need the opportunities there. That being said, though, on the sense of technology, Gravity DEX is standing out quite nicely. At least it has a lot of good traits. So I highlighted a couple here that I want to talk about here. There's a wide list here, but there's some down here actually around 6 to 7 that actually interested me, right? So improved order execution, right? So one big problem that you can run into if you're utilizing any AMM on the Ethereum blockchain is you basically have no framework to prevent people from front running you. And this actually becomes a very big issue because people who realize a certain opportunity to front run you where it makes sense will likely pay a higher gas fee, fill in their order first, and it can be to a degree of slippage where, you have to replace your trade and pay another network fee, and waste more time and possibly miss market opportunities and pay a higher price, right? Think about it as the kind of frustration of high frequency trading, but on a much more apparent degree, where you're inevitably paying a higher price than the market rate you probably agreed to or wanted to pay initially when you wanted to make the trade. What's really great here is that with this improved order execution, getting the actual market rate here and guaranteeing that you can't be front run is going to provide a much better trading experience. It's going to get you better market rates and make the use case of a DEX much more important, because you should care just as much not only about network fees and the liquidity provision fee that you're going to have to pay, which is always going to be around 0.3% to 0.4% if you're considering the network fee for most traders, but the slippage as well, the spread in this case that you're going to have to pay in order to make that trade, right? Now, in the sense of slippage as well, I want to talk about order number 7 here, which is the order book capability. My apologies. So order book capability is really important here because as much as AMMs are phenomenal technology, and let's be honest, most of the time for those of you guys who are trading out there, you guys are probably in the mindset of doing market orders, right? If you see an opportunity, you like getting in there, right? Now some of you might use limit orders and really actively day trade, and that's fine, but it isn't the majority of traders here, right? The ability though to have and satisfy both worlds is really, really great. To be able to satisfy the market orders of swapping instantly from one token to another. That's the beauty of AMMs, but also having a semi-order book functionality where you still can set in orders to be sold at specified price points, whether it be that you want to buy at a specific price point and swap your stable coins or another altcoin to another crypto, or vice versa, that you want to sell at a higher price. Having that limit order functionality is really great. And still to this day, Uniswap and a lot of AMMs don't offer that. Right? They're focused on dramatically simplifying it, keeping for the broad user base who just want to swap in and out of token. But for active traders and really bringing over some of that liquidity from centralized exchanges, we're going to need those traditional trading functionalities who know how to follow specified strategies that wait for specific order prices to get filled or certain standards to be met before placing trades. So again, these are the two ones that to me personally, I just want to share with you guys again. I'm here to basically showcase what I really like about it. These are two things that really get me excited, providing a better overall trading experience. But there's a whole list here of the overall ecosystem here where you can start to get a good idea of how Gravity DEX stands. You can see here that the testnet competition was a huge success here, nearly $1 billion in trading volume. You had a pool investment of around $190 million and over 715,000 transactions. On testnet, that's pretty impressive, right? And if this technology, so far it seemed in testnet, worked really well, I'm highly confident it's going to continue to work well and grow within the overall mainnet ecosystem. Now, one thing that I do want to talk about here, which is not so much exactly focused on just the Gravity DEX here, but Cosmos as an ecosystem. You know, as we talk about Tendermint, the consensus mechanism, it's also important to understand that practically every chain in this case, whether you're talking about Binance Smart Chain or you're talking about, for example, some of the new upcoming technologies built on the overall Cosmos ecosystem, such as Base Ledger from the Unibright and Provide ecosystem, the important thing to understand here is why proof of stake is going to be very, very impactful long term, right? No, I completely agree, and they even pointed out in this article here, I think this is a very relevant point to talk about, how Bitcoin overall, Bitcoin mining, whether it's energy consumption or yearly cost, is still dwarfed by a large institutional banking infrastructure, from gold mining, from all types of different commodity production out there. There are a lot of other bad villains in the world that outpace Bitcoin mining, electricity consumption, or yearly cost, right? That's understandable. But what isn't understandable here and is undeniable is the sheer fact of a per consumption basis. Per transaction you make, you're consuming way more than you would with a traditional bank transfer or other forms of energy consumption per engaging in certain types of activities. It's undeniable, guys. We can't ignore that. Now, of course, a lot of it could be renewable, etc. But the bottom line here is that we want to look for some consensus mechanisms that are nearly just as secure, if not just as secure, as proof of work, but also having the framework here where we can have less energy consumption. And this is a big focus of Cosmos as it's aiming to build out a variety of different chains. They crunch the numbers here. You guys are welcome to dive into the details if you'd like, but understanding what it takes to run validated consensus nodes on Cosmos to actually have a framework for consensus with over 100,000 Cosmos blockchains combined, you would still have less energy consumption than what Ethereum consumes per year. Now, of course, Ethereum is moving towards proof of stake, but the important thing to understand is that this is, again, focusing here on how Tendermint's consensus mechanism and how it actually validates authority is able to not only scale long-term, but also scale in an environmental sense. So I think this is really cool. Again, I've grown more and more supportive of proof of stake over the past few years. There just really hasn't been any cause for concern about proof of stake. There's a ton of academic research around it. So again, if you guys are looking for those layer one networks, again, most of them are taking the narrative of proof of stake as the focus for the future. It not only adds economic benefits for the token holders, but outside of that as well, and the end of it all allows for a framework for the network to scale. So again, stepping back here again towards Gravity, I again want to emphasize that you guys should definitely do some due diligence, take a look into the protocol, check it out for yourself. The bottom line is this: I think Cosmos as one of those ecosystems that could potentially be a part of the protocol wars is one to watch. It's definitely one that I think has been leading the way as we see major exchange platforms like Binance building within this ecosystem. But outside of that, we have a variety of other interesting projects, ones we've talked about here on the channel, like eMoney, Unibright, a lot of different players utilizing the Tendermint consensus framework and the SDK for Cosmos to build out their ecosystems. And as more of these really exciting ecosystems build and therefore bring users, liquidity, Cosmos has really seemed to win as a potential framework that could compete against Ethereum and other networks. And adding the bridge and other tools to bring existing assets from the Ethereum ecosystem into Cosmos, I gotta say, I think it's definitely giving Ethereum and other networks a run for its money in this case. So again, I recommend you guys do your own due diligence on it. I'd love to see Cosmos continue to build, continue to develop, but really don't have anything critical to say. I just think that, again, Cosmos, like any other layer one competitor, it's still in the early stages of reaching to the point where Ethereum is. But it's got a lot of assets under management, and it's certainly in the top 5 plays in this case, I think, for other competing layer ones, not to mention not only in the sense of liquidity, but also providing that user experience and bettering upon that user experience from what you can find on networks like Ethereum. So that's it for today's video, guys. Thank you all for letting me ramble as per usual. And if you like the rambling, give it a thumbs up. I always appreciate it if you guys show that support for the video. If you guys have any ideas, comments, or feedback or questions, you're always welcome to leave it down below in the comments. And I love to hear from you guys, so please feel free to do so. That being said, have a wonderful day, everyone, and I'll see you all in the next one. Take care, everyone.